see it? Looks okay? All right, good. And then this is the wrong setup also, but we shall make do. And well, it's not so bad. We can see what's going on. The Dow is down 350. The S&P is down. Now the Dow, we don't care about the Dow. The Dow is a stupid index, so we don't kind of ignore it. The S&P. Oh, I could bring my mic over here. How's that? Sorry, I've got a cold on the boat too, so my throat is scratchy. All right, so I'm not going to get into why the Dow is a terrible index, but it is. S&P 67.75. NASDAQ just under 25,000. That's a critical line. And of course, what we really care about is our, oh man, things aren't logged in. I think this happens to Kramer. I think he comes in and nothing is set up properly. Let's see, QQQQ, there it is. So what we're really watching, and again, the reason we haven't gone to cash yet is what we're really watching is this. We're still above that 600 line. This is what we call the must hold line. It's not even really 600, it's a little bit under 600, but this is what we call the must hold line, and it's holding. And this is a hourly chart, I think. How can you tell? Oh, there it is, 60 minutes. Okay, so this is an hourly chart. So we haven't been below 600 for even an entire day. Both of the times, all 3, 4 times we went below 600, we bounced right back. So that doesn't count. It does signal danger, but it doesn't count. Now, the more important thing though is here's your weak bounce line back to the highs, which we have never hit. We haven't actually made these highs, but so this is a weak bounce line, strong bounce line, strong retrace line, weak retrace line, and the top. So we are still in the middle of the entire range for the NASDAQ. So we're not in terrible shape. What is terrible shape is if we start ping-ponging in this range between the 50 and the 200 hours, don't forget. So between the 50 and the 200, if we're ping-ponging in here and we break down, that's going to look bad. But I could have said that here also, where we ping-ponged and we broke down. So that was a good reason to panic at the time, because that's very bad timing. You just blow through the average like that. But the thing is, this was an overnight break and we came right back during the day. So an overnight is obviously low volume and event driven, and this is what was this? This was war. We went to war. This was when the market opened and we dropped. We went to bed on the 28th and everything was fine. Well, no, it wasn't. I'm sorry. On the 28th we started bombing. So on the 28th, the future went down, then we went up because we thought it was going to be a limited thing like they did last time, and then it went down because it turned out not to be limited. Then we thought it would stay limited, and we thought they would open the straight. Then we found out they won't open the straight. Blah 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 blah. So this is going to go on for years. Get used to it. It's going to be very hard to predict. We went through this. We went through this in the other war in Iraq and Iran and Afghanistan. And we almost forget that kind of stuff. It's like you pay attention for a while, and then it becomes like the normal noises. It's 20 years later, and technology has changed, and Iraq has a cyber attack team that has done a lot of damage around the world. That's something that we've never seen before. Drone warfare is something we've never seen before. But the most concerning thing is that, and obviously Osama bin Laden attacked the World Trade Center, which was a clear civilian target, blah, blah, blah. So, obviously we're not the first people to break the rules of war, but we're the first major country to do it, other than Germany in World War II. We're the first major country to just violate the rules of war and just go, we're attacking, there's no resolution, Iran didn't start this, it's the same crap as we did when we went into Afghanistan. Just sit there and just claim that they're weapons of mass destruction, and that justifies everything you do. And after many decades of war, we get to the, as well, there are investigations all during that time, right? We went through several presidents during the Iran-Iraq war, the Iraq-Afghanistan war, and it turned out there were no weapons of mass destruction. There was no such thing. There was no provocation. There was no reason to go there. Osama bin Laden didn't attack from Afghanistan. It was all bullshit. Everything they said was bullshit, the Bush administration. And everything the Trump administration is saying now is bullshit. They're attacking because they want to. They want to get the oil, just like they attacked Venezuela. They want to get the oil. I don't know why they want Cuba. I don't know why they want Greenland. Those are crazy things. And yes, Greenland strategically, given the global situation and the fact that the Arctic is turning into an ocean again and will become an important passageway, then you can understand why we want Greenland. But we already have Greenland. We have agreements going back to World War II that says that we can build bases, we can build ports, we can do whatever we want up there. We already have all that. No reason to take the country over. Now, Cuba's a whole different thing. I'm not sure what we want. I guess we want sugar from Cuba, right? Because they want to ban artificial sweeteners, and that means we need a lot of sugar. So we need Cuba for the sugar. I don't think Trump smokes cigars. But anyway, so Cuba, Venezuela, it's all oil. That's what this is all about. And we don't know what's going to happen. It's too early, and it's not worth constantly speculating on what's going on. And it's funny, it's the world. This is how the world has changed, because 20 years ago, yes, we had the internet in 2001, but it wasn't like it is now. And everybody wasn't publishing their own newspapers, and there wasn't digital fakery and movie fakery. You have no idea whether a reporter is a real reporter or an AI reporter. And anything that happens is disseminated so quickly that it's around the world before anybody has a chance to check the facts. Oh, and we've dismantled real journalism and treating fake journalism like it's real. That's also terrifying, and especially in a war. The guy yesterday, I forgot his name, he's a real Trump official, was on CNBC, and he was sitting there on CNBC. I wait to check things. When somebody says something, I don't right away jump in and as soon as I hear it, I don't report on it. I wait until I can verify something. Now, I thought yesterday I had verified the guy on CNBC, because I heard him say the words that we had escorted here. He said we had escorted a tanker through the Strait of Hormuz with our military ships. Now, the day before, when Trump floated the idea on Monday, and he said, well, I think we'll just have the Navy escort the military ships. And I said, how can you escort 200 ships a day or 150 ships a day? How do you escort 150 ships a day through the Strait of Hormuz? You would need 500 vessels to escort 150 ships, or even if they somehow, you know, rotated in and out, 50 ships at least. We don't have 50 ships. So it didn't make any sense. But then the guy says we escorted the first ship. So even when he said that, I said, oh, well, we escorted a ship, but there's still 150 ships a day to do it. Escorting one ship doesn't prove anything. And not only that, though, they didn't fire. It doesn't prove anything. It doesn't prove you can protect them. It just proves that Iran didn't fire on the ship you escorted through. So anyway, it turned out all that was bullshit. The thing the official Trump administration guy was saying was completely not true. And so the oil market went like this, and then he retracted his statement, and it went right back up here. And now it's drifting along. And then yesterday it said, oh, the G7's gonna, have a plan with the International Energy Administration, blah, blah, blah. And then it turns out that as they tell us what their plan is really nothing other than, the world has 1 billion gallons, 1 billion barrels of oil in strategic reserves, and we're going to use 400 million of them to alleviate the prices. And meanwhile, you say, well, wait a minute. The world has 1 billion barrels of reserves. And as I was corrected by Bodie earlier, as Bodie said, he goes, don't forget that's just government reserves. That's not counting commercial stocks. Now, I don't count commercial stocks because, the oil that Virgin Airlines has put aside in their storage facility to fill up their jets is not going to heat your home. The commercial stocks are for the companies that own them. So unless the government goes around and starts seizing commercial inventory, it doesn't matter what our commercial stocks are. That's not what you have control over. You only have control over this in America, the Strategic Petroleum Reserve. And then you have to do the math, and you have to say, well, okay, 400 million sounds like a lot, but we're using 40% of our reserves in order to buy a month. So anybody who does math knows that 2 months would be 80% of our reserves used up, and then into the third month, we've used up all of our reserves, and now we have no reserves and no way to do anything about the price of oil in a crisis. So, this is very much like a mafia movie where the guy's pointing a gun to your head and he's like, dig a hole. And you know that they're going to shoot you, but you dig the hole because you want to at least be in a nice grave when you get shot. That's what we're doing. We're just putting ourselves in a worse position where we're going to have our backs up against the wall in order to buy a relief from the immediate pain of $150 oil. So that's where we are. And then earlier today, we did the math. Oh, look at me. All right. All right, so S&P, same as the NASDAQ. We're just drifting in this channel, top of the range, weak retrace, strong retrace. The NASDAQ and the S&P are doing the same thing, and the NYSE is doing the same thing. So as I wrote here, now don't forget, I wrote this before the war. The prior range is unlikely to be revisited without a significant negative event. This is a significant negative event. When does it become significant? The clock is ticking right now, because every day that oil is not going through the Strait of Hormuz, the oil won't be made up on the other side. But when the war ends, they won't put 200 ships a day through the Strait of Hormuz until they catch up. You know why? There aren't 200 ships, number one. Number two, the pipelines, infrastructure, and X, it's all interconnected. There's enough output capacity to allow 150 ships a day to fill up and go through the Strait of Hormuz. There's enough pipelines and enough terminals and enough docks and enough turnaround, enough people. There's 150 ships a day worth of everything because it's a very steady number that barely fluctuates on a year-to-year basis. If you want more ships, you have to build more terminals and more ships and hire more people and have more docks and put up more terminals. It's a lot. And everyone is now hurting for money because financially, we have let's say it's 150, just to make it easy. Let's say it's 150 million barrels of oil going through the Gulf, right? Times what are we at? 85. Well, times the normal 60, let's say, dollars a barrel. That's $9 billion a day is being lost by the oil producers. And then that amount of business is being lost by the shipping companies and the docks and everything else. All this entire chain, it's like when the government shuts down, right? Everything gets screwed and it doesn't unscrew. And with the oil though, oil is based on production. The AIs were talking a lot about tank tops. Tank tops means your storage is full. Your storage tanks are full. Once your storage tanks are full, you have to shut down your production. You got nowhere to put it. If you shut down the production of an oil wells run on a constant feed of pressurized gas and water. They usually, well, obviously water and water that gets pumped in to replace the oil that's coming out. And you know how oil like floats to the top, right? So they put water into a well, and it pushes the oil higher, and then they suck the oil off with a hose. That's basically how it works. So all that grinds to a halt, and it's to the extent, though, that if you stop working a well, it can seriously deteriorate, and then it's going to take you a very long time to get that well up and running again. So not only aren't they going to be able to make up what we lost in production, but they may not, but the future production may be impacted by this. So somebody somewhere is losing $9 billion a day. So if the war goes on for 30 days, that's $270 billion that's being impacted in the region. That's in a month. This is already day 11. So 20 days from now, that's the kind of losses that you're going to be looking at in the regions. The economic damage, because their economy is not like ours, the economic damage is tremendous. They have like an almost entirely oil economy. And you're not just impacting Iran, you're impacting all the places around it that push oil through the Strait of Hormuz. So lots of bad things. Let's put it that way. But I said, look, this is not a pullback. This is if this were happening and there wasn't a war, we'd be buying. We'd be like, oh, that's a tiny, nice little pullback. Test the 200-day moving average, or 200. Yeah, it is a day. So this one's day. So you test the 200-day moving average and you bounce back up. That's fine. That just shows you how strong the market is. The RSI has gotten low. The MACD lines have gotten low. And you see what happened here last time. We had the MACD down here. And this happened, and we were lower in November than we are now. And in November, we were like, let's buy. It's a great time to buy stuff. So here, the war obviously is different than just having a dip for no reason. And we're worried because if this does break, we don't know it's going to come back. Because of this. That's a real thing. That's a, you know, it's considered a drop in corporate earnings, a significant reduction in corporate earnings. That's what you're looking at there. We're in Q1, and all those oil companies, which is the lifeblood of the Middle East, and all the service companies and the drillers and the shippers and the blah, 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 all those companies are going to report terrible quarters. They're going to have a very bad, they're going to have poor earnings reports in the next cycle in June. I think most of them are semi-annual out there. And of course, the knock-on effect, the inflationary effect, and everything else that's damaging the rest of the world. So it's very interesting because you say, okay, they're going to produce 150 million barrels a day, not 150, 150 ships. Yeah, whatever it works out. 20 million. They're gonna reduce oil output by 20 million barrels a day. So there's less oil, but we're paying much more money for much less oil. And that's the thing. If you drove 100 miles last year and used 3 gallons of gas, okay, and it cost you $3 a gallon, or let's say $2.50 a gallon. So it cost you $2.50 a gallon. So that cost $7.50, right? What did you do? You went to work, or you went to do whatever for $7.50. Now this year, it cost you $5 a gallon. So it's going to cost you $15. It's twice as much money. What are you getting for the $7.50? What economic benefit are you getting for your $7.50 extra that you're paying? Nothing. You're making the same trip in the same car to the same place to do the same thing, but it costs more money now. That's the worst kind of inflation. That's disastrous inflation, because you know what? That's what they call stagflation. The economy, you going to whatever you have to do 100 miles from here for $5 is now, for $7.50 is now $15. You're doing the same thing. You're going the same distance. You're doing everything exactly the same, stagnant, but the prices are higher. See, the other kind of inflation is inflation that's driven by a overheating economy, like you know, you need more people to do more stuff because there's a demand for something, and you're increasing the size of the economy. That's inflationary growth. That's not bad. It's bad, but it's not, you know, I mean, it's bad, but it's manageable because more people are getting more jobs and have more money, and the wages are going up, and so on and so forth. That's what we've been having for the last few years. This is not that at all. This is simply paying more money for the same economy. That's the worst possible kind of inflation. And that's how you lead to then job losses and so on and so forth. In fact, Sherlock made a comment. I will get to it, I guess. Sherlock made a comment saying, you know, it was Uber. Uber is partnering with somebody for the self-driving Ubers and whatever. And that's great, except we have 20 million Uber drivers now. Not just America, the whole world. And it's not just Uber. Uber is 10 million. Uber officially has 10 million drivers around the world. Lyft and everybody else, all the other car services have another 10 million. So that's 20 million. And we're rapidly moving towards replacing them all. That's a lot of freaking people to not have a job. And it's already not a great job, but now you're being kicked out of that. So, you know, on its own, this isn't bad, but the problem is the situation has changed, and right here is a significant negative event. This is absolutely a significant negative event. It just is the first 10 days of the event out of 30. If this thing goes 30 days, no one's going to question whether or not this is significant. 10 days from now, probably nobody's going to question it's significant. Right now, while the government is pretending this is going to be okay, and while they're making this fairy tale about releasing the SPRs and blah, 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 they make it sound like it's not as bad as it is. but it's bad. And they knew this, by the way. I mean, there's no way. How could they not know this would happen? This is, I mean, you know, any half-assed economist in the world would say, this is what's going to happen if you invade Iran. This is exactly what happens when you invade Iran. There's no doubt that this would happen. I mean, it's the same thing as, it literally is the exact same playbook as when we went into Iraq and they said, oh, we'll be greeted as liberators and they will rally on the streets and they will throw Saddam out and whatever, blah, 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 bullshit. It's exactly the same thing. But it was 20 years ago, so nobody remembers apparently. I don't understand. I really, nobody, you know, World War II, nobody remembers that at all. Nobody thinks that. I've been drawing comparisons, people like, oh, you can't compare Trump to Hitler. I'm like, but he's doing the same thing Hitler did. What am I supposed to do? I'm supposed to ignore the fact that he's doing the exact same thing Hitler did? You were allowed to compare people to Caesar. Oh, Caesar did this and Caesar did that, or even other wars. You can study generals, what Napoleon did, so on and so forth. Well, that's okay. But if you do something that Hitler did, everybody has to pretend you didn't do it. That doesn't make any sense. That's the comparison. That's what he's been doing. And this is terrible. This is, you know, so Trump is like Bush. Let's keep it that way. Anyway, this is the month of March. Microsoft, you know, well, Microsoft, our buddies at Oracle are having a very nice day today. Palantir, CrowdStrike, Broadcom. I love Broadcom, NVIDIA. Well, what can you do? Everybody's getting together. Everybody is getting together. It's big news today. Microsoft, Facebook, whoever the hell else, and they're all getting together to make their own chips because NVIDIA are greedy bastards and are, you know, charging 100% markups on their chips, more than 100, 200% markups on their chips. They're profiteering. So everybody wants to get rid of them. And the problem with doing that is not, you know, and yeah, of course there's a shortage, but a shortage doesn't mean you should charge whatever. You just say we're running out of chips. Not I'll give you chips if you give me this. And NVIDIA, in fact, just invested. This is what they're doing. They play games. They invested in a company, and their investment is to give them chips that nobody else can get. So they're lowballing the investment because without their investment, these guys wouldn't have the chips to build their data center, and they're probably sticking it to these guys on valuation. And not to mention the fact that they're marking up their chips 200%. So they're giving these guys chips that they couldn't possibly get on the open market, and they're giving it to them at full price, and they're calling that their investment, and they're probably giving them a shitty valuation. Take it. So yeah, invest in NVIDIA. They're evil bastards, just like Microsoft used to be. When Bill Gates ran Microsoft, they were the most evil bastards on the planet. Everybody forgets what a prick he was. He's like a saint now because he gives away all his money, but he was a son of a bitch as a businessman. He squeezed every single competitor out of business. Anybody challenged them, he would just buy up the competitors or buy their pipeline or make it impossible for them to do business. It was awful. But we were busy fighting a war back then, so nobody was paying attention. So these guys, so we got software infrastructure and semis doing well in a war anyway, reasonably well. IBM having a little bit of troubles at the moment, but okay. Intuit, ServiceNow, Adobe, who's been badmouthed, Amazon, who just got 3 of their facilities blown up in the middle, not blown up, but you know, drone strikes hit 3 of their facilities, and 2 of them were pretty badly damaged, and one is I think one they kind of missed, but it had some damage. But that's the thing now too, because your war machine relies on AI. AI is embedded into the war machine, and now strategically, Iran is like, which we are learning from the Ukraine, right? We're learning from that war. Iran has said, oh yeah, that's a good idea. Like, let's take out their ability to communicate. Like you saw this stuff where Elon turns off the Starlink when he feels like it and cripples countries. That's now a tactic. So, but that again, you're breaking barriers, because as you start saying, oh, businesses can now decide what side of a war they're on and tussle with the enemy. That's like, that was never done before. You know, Berkshire Hathaway didn't get a bunch of cannons and go to the front lines in Afghanistan. I mean, that's a little nutty. They might have made the uniforms, but anyway, so this is a month, not a lot of green at all. Here's our buddies at Raytheon. Here's Northrop Grumman. It's General Dynamics. Lockheed Martin is kind of flat, but they had a phenomenal run. I mean, you know, there's no question of them. Here's Exxon, surprisingly down. Chevron. I mean, how does Exxon down? Don't they sell oil? You can count their money coming in. That's kind of weird, right? Here's Conoco. They're about flat. EOG, PSX, but, you know, oil and gas is a little green over here. But honestly, this is a sad chart. Oh, you know what? Why don't we do it like this? This is where I get the chart from. You go to FinViz on the main page. I don't know if you have to be a paid subscriber or not. I'm elite. Thank you. Yes, that's right. I'm elite. So you just go to FinViz, and here's the live chart. The live chart's a little bit cooler. So if we just do the same thing, month to date. Whoa. So as you put it over, what it highlights the thing you're looking at, right? And then it shows you the rest of the sector at the same time, like very laid out. It's very nice for browsing. You know, for me, you know, I can. It's a real great view to be able to see this like this. It's wonderful. Just mouse into the sector and it shows you what everybody's doing in the sector. See targets outperforming. Target's the one we like. Here's Coca-Cola. Here's Pepsi-Cola. They're both stocks we want to buy in this market. But not while they're falling. Let's give them a chance. Caterpillar, surprisingly. Oh, and they also have the little chart. I can't point to it. I'm pointing my finger here. See, the little chart comes up, and that's helpful too. Now, what's the premise on Caterpillar? Caterpillar, you know, they've got the heavy equipment for the miners, for the minerals, for the rare earth things, for the farming. But you know what? A lot of that is a problem when the world is having a war. What is it? Turn swords into plowshares or something like that. This is the kind of the opposite, right? So you're turning plowshares into swords in this environment. And that's actually a good point, though. You know, think about how flip-flopped and out the window logic is, right? Because they talk about making swords into plowshares, and you know, it's just an old expression. It's like, what do you do with the metal? You turn it into farm equipment. But now we're the money is getting drained away from that. The banks aren't lending on it, and so on and so forth. The fertilizer shipments are stopping. There's so many problems because of this stupid freaking war. Procter & Gamble getting hit hard again with the inflation squeezes now. Kimberly-Clark, Clorox even. I mean, Clorox is down 11%. That's, you know, what do they do? They're just trying to clean things up. Philip Morris, supposed to be a safe stock? No. The railroads. So this is awful. This is a really, really bad month of March. There is nowhere to hide. And this is what I was talking about with the members also. Oh, well, let's get to that. Yeah. So I was talking about the members. I'm like, you can't just say, you know, you can't say, oh, I've got this and that stock. This is a broad sell-off. It's going to get very ugly. And the Magnificent Seven is the safety zone right now. People are still, because here's the war starting, and they went down, they went up, they went down, they went up. You know, because this is the largest segment of the market. This is the Magnificent Seven. These guys. Here's your Magnificent Seven. That's Saudi Aramco. That's silver. That's the only thing that's not Magnificent Seven up here. Oh, some Bitcoin, right? This is gold, by the way. This is very important. This is gold now. Here's the Magnificent Seven. Gold is bigger than the Magnificent Seven. And gold used to be a quarter, not a quarter of a Magnificent Seven. But gold used to be, a year ago, gold was half of what it is now. So all this is gold. Well, yeah, all this is gold crushing into everybody else's shares. Staggering amounts of money has been put into gold. And then I talked about how here, this is just 2025. So here's Trump taking office, and here's the money supply. And did it do this under Biden? No. It went up and down a bit, but it really was not that impacted, although we were dumping a lot of money into COVID and whatever's. But this is crazy. 5% in a year is not sustainable. You can't just throw money into the country like that and just keep printing bills. It's going to cause inflation. And then Trump complains about the Fed tightening or anything. He's like, that causes inflation too. And then he starts a war that drives the price of oil up. That's inflation too. And meanwhile, everyone's telling you there's no inflation. It's just insane. So I said that's a dynamic that's been driving the markets. The money did not go into gold. The money that didn't go into gold has been going into stocks, and the reason gold was able to gain $13.5 trillion in a year is because half of the world's gold is in jewelry. Oh, I had a chart for that. Did I use it? I had such a good chart for that. Oh, did I make a link? Oh, there's such a nice chart, and I was going to use it. So interesting. Half of the world's total gold supply is in your wife's ear and on her finger, and whatever crap you have around the house is gold plated. Think about it, it's not just you. There's 8 billion people, and all of us like gold. So if, well, they're going to get technical, right? So if 8 billion people divided by 16, 500 million ounces of gold, if just 8 billion people have an ounce of gold. I'm sorry, it's pounds, not ounces. 500 million pounds of gold. Oh yeah, I was going to divide that by 2,000. Make tons. 250,000. So 250,000 tons of gold are just the stuff that people have in their house and wear around their wrist and so on and so forth. Your phone also has 6% of the world's gold is in phones and other electronics that you actually, people throw out. That's crazy too. And what was the other one? Oh, central banks. And central banks have 25% of the gold. So the rest, the part that's invested, is only 18%. So it's like Bitcoin. Only a small portion of it is actually traded, and that's why there's such incredible leverage on the movement of it, because it only takes a little bit of well, I don't want to say physical for Bitcoin, but for gold, there's only a little bit of physical demand can cause everything to spike. Silver too. That's why silver went insane, because as soon as people started demanding physical silver, there is no physical silver. It's all being used. It's a commercial product. Gold is not so much a commercial product, but the point is just like Bitcoin, when somebody buys gold, they tend to just keep it. Most gold in the world is bought by people who want a gold earring and want a gold chain and want a gold cross, whatever. That's where most of the gold in the world goes. So it's taken out of circulation, and that means that literally half of what's produced every year is taken out of circulation by people going to jewelry stores. That's where it goes. What's this? Oil. And here's oil. So oil was drifting around 60 most of last year, and now it's up at 86, which is significantly higher than 60, right? It's almost 50% higher than 60. And it almost hit 120, which would be 100% higher. You can't afford that. You know, you go to the gas station. I don't know about you guys, but I mean, I pay $50 almost every time I go to the gas station. It's at least $50 is normal. I don't even blink at $50. When it goes to, if I pay 75, I go, what? Why was it 75? It's like if the tank was empty. You start paying over $100 for oil. You start paying $100 to fill up your tank. That's upsetting. That's definitely, that extra $50 is definitely something you're not doing the next day or the same day or that week. You're saying, hey, I just spent that money. So you have two choices. You either start taking out more money for the week to cover your expenses, or you have to cut your expenses. You have to cut what you're doing. So something's got to go. And again, what are you doing? You're getting absolutely no utility value out of that extra oil, out of that extra money on the oil. You're just spending more money for the same freaking thing that does the same job with your car. That is not a good way to spend money. And that is in turn causing the trucking expenses to go up, and they're going to pass that along to you as well. So you're going to pay for the truckers' extra fuel charges. You're going to pay for the grocers' extra fuel charges and the farmers' extra fuel charges. And it's inflation, 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 inflation. We're only 10 days into this. So, and it's the end of the first quarter. Well, it's the last month of the first quarter. So we already had 2 okay months in the first quarter. Even if this month looks pretty bad, it's not going to be terrible on a quarterly basis. But next quarter, we're going to be starting at $85. So again, if this is going on at the end of this month, if this is still where we are, things are going to start getting ugly fast, because you're going to open Q2 with this incredible surge of inflation. Right off the bat, there'll be no escaping it anywhere, and the war will be continuing, and the strategic reserves will be getting depleted, and people will be super pissed off. Oh, oil is now 87.77. It keeps climbing. It's up 5% today. And again, this is after the G7 thing that caused oil to go down early. This is ugly, ugly, ugly. And and again, everything good is based on the fact that people are saying, oh, this will blow over quickly. And what's all this about? Why am I going over all this stuff today? Because I'm very on the fence right now about cashing out. In the very least, we're going to hedge the crap out of our portfolios by Friday. But even that, though, is that going to be enough? And is that worth what we're doing? We're taking, we're just doing all this to do what? To stay even? You know what stays even? Cash. You cash out. You stay even. You don't need to hedge. You don't have to worry about balancing. Cash out, wait a month, see if the world ends. If it doesn't end, and if the war seems like there's two ways. I mean, either the war can seem like it's winding down in a month, and I mean the end of April. The war either seems like it's winding down, or it seems like it's never going to wind down, like Afghanistan. And that being the case, you'll start getting used to it. That then things get what they call priced in. So that's where we are. We're kind of waiting for one or the other. And so if we take 30 days, 45 days off, 60 days off, from trading, get back into cash. And we did this last year. That's why our portfolio started in June of last year. In May of last year, we cashed everything out because we were worried about what was going to happen because of Trump's tariffs and everything, right? So we cashed out. The February dip, we had that February dip. It was horrible. And then the market came back, and then we cashed out in more, late March, whatever. And we cashed out of our portfolios. So I was like, I'm not going to risk that again. That was insane. And all he did was delay the tariffs. He didn't take them away. So so we cashed out, then we had the cash, and then in June, when everything seemed normal, even though the tariffs were back on, we were used to them. They were part of our investing climate. We could adjust to it, and we could look at how it actually affected each company in our portfolio. So we started rebuilding back in June. It's been fantastic since then. The market was like straight up since June. In fact, here's the S&P. So here's that dip. So Trump takes office, the market sells off because of his tariffs. They started coming back up, and around June we said, oh, okay, we'll start buying this, and we didn't miss anything. Went right back up. We got out here, the market went here, we got back in around the same place, and then it went up again. You know what we skipped? We skipped this big downturn that would have been a pain in the ass. So all I want to do now is skip the big downturn. This big downturn could come all the way back down to here. This is a good video. All right, good. Got through that. See if anybody's got questions. Somebody's got a big question. Bradley. Bradley says, within power options, is it correct it only reports the returns based on the position and cash that it sees, but ignores the extra capital necessary to set aside margin? No, it has a margin requirement. Is it true that you would say that it might be possible for the 700? Actually, it doesn't have a margin. It treats everything like it's a no margin account. Is it true that you would say it might be possible for the $700 a month portfolio to actually be producing better returns versus the LTP based on both risk return and also capital efficiency? Is it true that you would say it might be possible for the $700 a month portfolio to be producing better returns? No, you lost me there. No, you're not going to produce better returns without margin, other than in a downturn, you could produce better returns because the margin can kill you in a downturn. That's really why the $700 a month portfolio is so strong, is because it isn't using margin. Therefore, we're very well covered on our positions. We don't have any risks. We don't have any puts, short puts. That's a huge advantage. So in that case, that's the advantage of the $700 a month portfolio in a downturn, is we don't have the margin risk, which frankly, when you're in a very small account, you should never use margin risk anyway. That's for the big boys. And Jorge says, when you go cash, do you mean closing all positions, including those that we're opening these days, and hedges? I don't know for sure. Last year we cashed everything out. We didn't cash some things out. We cashed everything out last year, except for we left the Money Talk portfolio open and the $700 a month portfolio. But we cashed out the LTP, the STP. We had a dividend portfolio and an income we had a dividend portfolio, and I think we had another one. I mean, we never put them back because we decided they were kind of a waste of time. So, is this, yeah, okay, I guess that's the first comment. So then we do what we usually do, which is we have the AGI roundtable take a look at the day's events and give us the opening. We used to have Zephyr and Warren give us the opening, but I like this much better. No one's ever given me an opinion otherwise, but I think this is phenomenal reporting. I mean, if I want to go somewhere and get the best possible overview of the day, I don't know of one better than this, and I subscribe to like everybody. I don't know where I could find a better overview of the day than what these guys give you. This is our AIs. They absorb all the news. They read everything that happened everywhere, and and they come up, they pick. I don't tell them what to pick. I say, you know, give us a report from the morning. This is what they choose to report. But there's two sections. There's the first section has the main news, and then I say, then I tell Gemini also. I said, go. Well, here I asked him to specifically have them review my article for today, to go over it, to make sure we're hammering our points home properly and get their opinions. Here I do every day. I say add some things that haven't been discussed. I say go through things that go through the news again and pick out things that are, I'm sorry, I don't say, and have the roundtable, have some of the other roundtable AIs go through this and then tell us what they think is the most important thing of the day, something that they think people aren't paying attention to. And I find this one fascinating. You know, so sign in, and they've all got their own personality, so they all look at things a certain way. These labels are Gemini's opinion. They're not like, it's not sign in thinks to himself this way, but this is how Gemini classifies everybody. So sign in talks about Oracle's earnings. He talks about the other companies getting together to try to make their own chips. Cyrano talks about the trend he's picking up on is, oh, here's the Google, Amazon, Meta. People are trying to reduce the token consumption of the chips, so they're using less electricity per request, and that's important too. Sherlock is talking about the autonomous transit, the Uber thing, Uber and Zoox, and here he said, sorry about the 20 million humans who are displaced by this technology. Anya is very big on, she likes the human side of the market psychology and stuff. She's fascinated by that. So she looks for stories like that. And in this case, Target is slashing prices. Now that's good, that's deflationary, but it's not good for Target. And it's going to put pressure on everybody else. But we like Target because they're good operators, and they're adjusting the way they need to adjust to get things done. And then Starboard is pushing CarMax to cut costs. So, you know, this is what you're going to see now. You're going to see margin squeezes, cost cutting, so on and so forth. That's not necessarily good for the markets. And Jubal, he likes legal stuff. He's a doctor and a lawyer, Jubal. He likes legal stuff, and so he sees something like this, he gets interested. If it would, who is it? Stars, right? Yeah, Stars Entertainment is being messed around with. Victory Capital's buyout thing is interesting also. Rowan, he's looking at Canal Plus, another big media deal with Canal Plus. They're using, now this was bound to happen, they're the first major network that, because they're just as important as CBS or NBC or anybody else, they're the first major network to break and say, you know what, we're going to allow AI content. So if you're producing a show and you want to use AI content to make scenes, it's fine with us. Now, if they don't get a lot of backlash, that's going to spread real quickly, because all of a sudden the cost of producing a Star Trek episode drops in half if you can use AI. Because everything's there. If you've got a team of people who know how to stitch together videos, you can create you can create some really exciting space battles and ship scenes and all kinds of stuff like that. Can be quickly done with AI, like quickly, like 5 minutes versus 10 days in Korea. And it's going to change a lot of stuff. And eventually they'll start writing the shows, and they'll start having the actors will be AI and everything else. And it's going to be a nightmare for Hollywood. This is the first break in the dam now. Is that Canal Plus is allowing it. And he says we're officially crossing the threshold where generating highly realistic multimodal video from thin air is becoming standard accessible utility. Uh-oh. I don't know how long my voice will go. That's bad. Anyway, so that is my favorite thing that they do. And I have to ask that separately. That's after the report they usually give. I say, well, what else is there? So go find me some cool stuff. But so here I said, here I said, analyze what I said and tell me if I missed anything or if there's something else to add. So they all looked and read my morning post and kind of reviewed it. So we talked about the strategy. We'll talk about this in the portfolio, hopefully, if I have enough air. This is what's important, though. I said, look at your portfolios this morning. You can't be a deer in the headlights looking at your portfolio go up and down 5%. Because all it takes is 2 days in a row of down. Like, it goes up one day, down one day, up one day, down one day. But all it takes is 2 down days, and suddenly you're down 10%. And then what do? Well, unfortunately, human nature says you stare at it some more. And you hope that you get back your 10%. But that's what you were hoping when you were down 5%. Now you're down 10%. That's how these sell-offs go. They step down. And so then you're hoping that your 90% comes back, but instead it goes to 85%. And then you're like, oh shit. Do you want to lock in your 85%? You want to lock in your 15% loss, or do you want to? And it's, by the way, it's not a 15% loss when you're already up for the year. It's only a loss from the top. That's another thing people don't realize. I say that a lot. I say that your gains are part of your protection. But only if you can let it go. Only if you can say, you know what, I got a good amount of money here, I'm going to cash out. And when we find a real bottom, and it doesn't have to be a real bottom for the whole market, but if you find a real bottom, like just today, I said, why don't we buy some GLW? Why don't we buy some Nike? Because when you find a stock that gets so cheap that you can't see any reason not to buy it, that's when you start building back in. And that's why last year, our June portfolios did so well. Long-term portfolio and short-term portfolio only from June of last year. Why did they do so well? Because this is what we did. We cashed out, and then we looked around and said, what are the best possible things to buy? And we built a base of really, really low-priced stocks. So I said, you can't deer in your headlights through this thing. You have to step back now and start thinking, why am I not cashing out? Not should I cash out? Why am I not cashing out? Why am I not taking the 90% from the top, not 90%, whatever you call it, 10% off the top? Why am I not taking this 10% off the top or 5% off the top where we are now and saying, I'll take it, it's cash, let's go, I'm done. That was a good year of trading. Let's see what happens in April and May. And then we can start buying again. I don't mind not having run the portfolios for a year when they're up 100%. They're fine. That goes back to that question somebody asked before, right? Somebody just asked that question. Whoa, what happened? Son of a bitch. What did I do? I feel like you did something bad. Shit. It's all still here. That's what we're. Oh, boy. Questions. Okay, so the butterfly portfolio never returned. Right. Thank you, Bradley. So yeah, we had a butterfly portfolio too. You know why so much stuff was redundant and we play butterfly plays in the LTP all the time, so I didn't see the point. And it's so much work for me. Even now, I'm back to like it's a whole week for me to go over these portfolios. And honestly, you guys would rather have me spending the time reading and watching for trends, not reviewing shit we already traded. I spend so much of my time doing that. And then I like now I've been quiet well, for me, I've been relatively quiet the last few days because I've been reading and reading and reading when the war's on. I'm reading everything I possibly can and getting all the reports I possibly can to try to figure out what the hell is happening. Because he sure as hell can't trust the president to tell you. So that's what I say. I say maybe Trump is a stable genius and the war ends quickly and Iran kisses his ring and Israel has all their neighbors over for a Passover feast and everything will be hunky-dory for the rest of the year. That's possible, and that is a scenario in which we could now go from, let's say we're at 95% now, so that would be the scenario in which our portfolios go from 95% up 10% from here, and we're at 105%. That's possible, but maybe not, and the war continues and travel and trade are disrupted in Q2. And oil inflation starts getting obvious and everything is a disaster. Then your portfolio, instead of being at 95%, goes down to 85% or 80%. And then, as one of my AI, I think it's Bodie or Warren pointed out, he goes, don't forget that if your portfolio is down 20%, you need to gain 25%, right? 80 plus 25 is 100, 80 plus 25%. You need to gain 25% just to get back to where you were. Whereas if you cash out at 90% and the market falls to 80% and you get back in and the market comes back 20%, now you have 108%. 90 plus 20% is 108%. Cashing out is better than hanging on. And I'm not saying cash out yet. That's why we start out looking at the charts, okay? You got to take the emotion out of this and say, there's my line in the sand. If this breaks, I'm cashing out. I don't care what the number on my portfolio is. It's time to get out. We don't know. We don't know what's going to happen next. We don't know what's going to blow up next. We don't know who's going to get killed next. We don't know what, they just, Iran literally just attacked Amazon specifically on purpose, not accidentally. They attacked Amazon's data centers in the Middle East. They consider U.S. corporations to be enemy combatants. That's not normal. We don't have a pattern to fall back on here. Okay, so it's not about the odds of which is going to happen. Okay, it's not about is Trump a genius or is Trump an idiot, and what is it 50-50, is it 60-40, blah blah blah. That's not the important thing. That's why the poly markets really confuse people. It doesn't matter which of these is right. What matters is what the relative outcome is if one of those is right. So if everything is great and we go back to our highs are not very far up from here. 5% from where we are now is the highs of the market. But if Trump is lying to us and this is going to be a long, drawn out, disastrous war for the US, just like every war we've been in for the last 80 years has been a drawn out disaster. Well, what war have we successfully prosecuted since World War II? Vietnam, Korea, where did we exit with dignity? Even Afghanistan, did we exit with dignity? We gave up. We just walked away. Freaking Taliban are in control of that country now. I mean, seriously, this is the funniest thing. It's like we couldn't beat Afghanistan. Iran is a way more powerful country than Afghanistan. Afghanistan's 20 million freaking people. Iran has 90 million people and a massive oil economy, and they've been on a war footing forever. And we think we're going to easily beat Iran when we couldn't even beat Afghanistan? So anyway, the downside is so much worse than the upside that there's no point in playing. If I flip a coin and I say heads you win a nickel and tails you lose a quarter. That's the game. Not pick heads or tails. If it's heads, you win a nickel, and if it's tails, you lose a quarter. That's what they call asymmetry. The risk rewards are asymmetrical, not even. The odds are even, but the risk and reward is not even. Therefore, the logical thing is don't play the game, which is essentially what other US presidents have done with Iran. Don't play the game. The risk, the damage that can be caused by starting a war with Iran is way, way, way worse than winning. What is winning? How do you say you won? By taking over their government? That's Trump's little fantasy. Although he took over our government, so I guess he figures he can take over any government. Oh, best case scenario with Trump. The best case scenario I see with Trump is he already backdoored this deal with the new supreme leader, with Khomeini's son, because Khomeini's son is a real estate guy. He's somebody probably Trump knows people in his circles, and he's a multi-billionaire. He's got interests to protect and so on and so forth. For all we know, he wanted to get rid of his father and take over. And it's possible that he made a deal. So that would be the best case scenario, is that Trump Trump was being Trump and made a deal to assassinate his father and put him in charge. And now they're going to make it look like a war for a little while. And then Trump's going to go over there and shake his hand. And he's going to get his Nobel Peace Prize for stopping this war that he started. That would be the best case. And if that happens, then the market's going to be great. So the question is, how ugly does this get over the next couple of weeks, and does it resolve quickly? And if neither of those things happen in 2 weeks, then I can't imagine that there was ever any kind of good plan out of this thing. And then we got to pull the plug anyway. So, every day the war goes on, it gets worse and worse. That's all there is about it. I said, if everything is suddenly fine, we're still in an overbought toppy market, and we're going to try to grind out quarterly gain selling premium. If everything's not fine, we just reset our portfolio with new stocks that are good to buy, and we go back to our premium selling game. And then Warren chipped in. This is Warren. And Warren chips in, and he starts talking about game theory and asymmetric outcomes, what to do under various SWOT analysis. You guys went to business school, should know that. And strengths, weaknesses, opportunities, threats. That's what SWOT is. SWOT. Strength, weakness, opportunities, threats. You lay everything out and figure out what your best course of action is. And the main point he makes is it's a portfolio management is just, which is Warren Buffett's rule number one: don't lose money. If you don't lose money, everything will be fine. But if you lose money, you are restricting your options. You're restricting your ability to do something about the situation. And that's why cash is better. It just makes sure you don't get worse and you have an opportunity in the future. Like Bitcoin, we bought BTC while it was really low, and now it's back over 70,000. I think it's going to start squeezing back up now. I talked about the data centers. And again, this is another great thing about having these AIs handy, because it's like I go, on the news. Oh, and even CNBC, I gotta hand it to whoever did that. The guy in CNBC said, we have verified this by 5 sources. This really happened. Because something like this, it's like, did this actually happen? And Bodie's looking for that too. Bodie knows to check. He's like, did this really happen? Because I said it to the members, and then I immediately go back to Bodie. I'm like, did this really happen? Like, please check for me. Because you don't know these days. You have no idea whether anything is true. So yes, Iran struck 3 data centers. The dollar is pushing everything down because the dollar is high. And we're using 400 million barrels of oil. All that is like, not this, but this is phenomenal news, and oil is going up because it's not enough. And if that's not enough, and that's only going to cover us for a month, then what happens next month? We're going to use up all the rest of our reserves just to try to pretend that it's okay. Here's Nike, like super cheap. And I said, if I were in cash, so it wasn't an official trade, I would sell the GLW because the VIX is so high. You're getting these great prices to selling puts. Why? Because everybody's covering and in fear. 80 is way down here. Can I make that bigger? Oh, I can. Look at that. GLW is at 132. The $80 puts, no, I'm sorry, the $100 puts can be sold for 20 bucks. That nets you in for 80. 80 is like 40-something% below the current price. That's a good use of money, or a good use of margin anyway. It's so far out of the money and you're getting such a great price. Why would you not want to take it? All right, and so last thing we're going to do is go back to, hang on. Marco says, when you mention cashing out, but also recommend stocks like Nike for the STP, is that haiku? If I was cashed out, I just said that about GLW. If just because I've added a trade doesn't mean I still might not go to cash. And if I go to cash, it doesn't mean I'm going to sell all, I don't want any of the short puts. And as I said, if I were in cash and didn't have other obligations, then I would love to do GLW, the short puts. Because as soon as you go to cash, you go back to your watch list and say, what do we want to add? At what point do we feel comfortable adding these things back? And so for Nike and GLW, this point right now, I feel comfortable adding them back. There's always going to be something I want. There's always going to be something to buy. You're saying saying we're going to cash doesn't mean every single stock, all 6,000 whatever stocks suck. We're going to find 50 stocks that are good, 1%. We're going to find 1% of the stocks and say, these stocks we want. These stocks we want now. These stocks we want even though there's a war. These are the stocks we want even though the market's going to crash. These are the stocks we want even though we think there's going to be a recession. There's going to be 60 of those. And we're going to and don't forget with Nike and the other one. Nike was saying Nike, I'm saying I'll buy it for another 30% off. I'm going to be interested. And with GLW too, I'll buy it, but for another 40% off, I'll buy GLW. It's probably not going to happen, but if it does happen, that's one of the stocks I want to rebuild my next portfolio with. And Nike's got a big ass refund coming from the tariffs if it ever goes through. So where were we? Oh yeah. Things are not absolute. Let's put it that way. You can't keep thinking everything has to be absolute because that's just not going to happen. So here's how to become a millionaire by investing $700 a month. And this is our 43rd month. So we rode this out through the dip. Or dips, a couple of dips. So what we do every month when we do this is we say we're at $101,000. We're adding $8,400 a year. That's 700 times 12. It'll take, I do this after the fact, but then I figure out, okay, it's going to take us 4.2 years to get to $1 million now. That's that number. When we started, don't forget it was 30 years. We're 4 years into this. We're not even 4 years. So 48 months will be 4 years. So we're 3.5 years into this. We only have 4.2 years to go. We originally planned on 30 years. We expected 30 years at 10%, but we've been getting a 66% return. And that means that we can actually get to $1 million in just 4 years, which is crazy. But of course, 4 years ago, starting with $700, if you had told us we'd be at $100,000, that would have seemed crazy, right? So, if you don't lose money, if you follow these things, you will learn that you can make this kind of money, and I'll show you how. Well, hell, that Oracle trade. Well, all right, let's stay on this subject. Remind me of that Oracle after. Oh, I'm not gonna make it that long. Okay, so again, AI's, the efficiency. You know, I didn't used to have time for this crap or inclinations, a lot of writing and a lot of work and whatever. But I said to Bodie, I said, hey, give us a status update on the stocks. And he says, okay, so looking at the portfolio, given the current situation, what should we do? And he says, keep. Well, he said he liked everything. And he said, why? And then he gave us a little summary of each one. I mean, this is freaking fantastic. I just had to ask him this, and he writes. It's not just that he tells me; he writes it all down, and I can just paste it over. We have so much more information than we would have had before. It's a video on it, and again, you know, I'm able to make these videos and get this stuff done. It's incredible. Oop, I should have bolded that. I didn't. These are all the ones you can track. You can go back on them. So we only have 58,000 in positions, 42,000 in cash, and we have our SQQ hedge. All right, I don't have time and I don't have the voice, so I'm not going to go back and forth constantly. We're just going to look at it. Helen of Troy, we're rolling and improving the position. So what are we doing with our $42,000 of cash, right? What are we going to do? We're not buying new positions, but what we did is we improved the positions we have. And just because I improved them doesn't mean I'm not going to cash them out. It means that at the moment, the correct course of action is to improve our positions. So that's what we're doing. Given the situation, given where we are, given the fact that we still like all these stocks, we're just improving them when we can. So Helen of Troy, we improved. And I said here, you know, I said, what are we doing here? And then same in most of our adjustments, we're taking advantage of the high VIX to sell more premium. At 25, the VIX is usually 15, which means it's 40% over its usual number. So we're selling 40% more premium than we usually get to sell. That's fantastic. That's like renting your rooms out during Super Bowl. You're getting a huge bonus for doing the same thing. We're the ones causing inflation. We're the ones who are giving somebody the same option we would have gave them last week, except now we're charging 40% more. So of course we want to do that in every nook and cranny we can find. Path we left alone. I think it's ridiculously cheap. And Path is, you know, Path is an SAS that got thrown out with everything else. But they're not like that. They're AI process development. They're the ones that are putting the AIs in that are making everybody else go out of work. It's a chicken and egg, right? You need somebody to put the AI in to the company so the company can fire everybody. It doesn't matter, you know, the AI doesn't knock on your, you know, the AI doesn't go, well, AI, like Land Shark. Remember Land Shark from Saturday Night? Land Shark. That's what this is, like AI, hello. No, people come and do a presentation and they work with the programmers who they're going to make obsolete, and they work with the employees they're going to make obsolete, and they install the AI system that takes everybody's job. That has to happen first. It's not a question of the chicken or the egg. You have to have the AI installed in order to start laying people off, and that's what Path does. United Airlines, obviously horrible, right? But airlines hedge. Airlines buy futures contracts. So United Airlines is not going to let themselves pay $120 for oil. They almost did, and that's why you got this big crash down here, like it fell so fast. But because the oil went up so fast that I could even imagine that United Airlines hadn't had time to decide what they were going to hedge. But now oil is back to 85, or it was this morning, and all they have to do is buy, let's say they buy 30% of their oil for the next 2 years at the current prices. And We did this the other day. It's very important to look at. So many things are important, aren't they? NYMEX? No, it's not NYMEX. Is it NYMEX? NYMEX. If I could spell the NYMEX, there you go, commodity prices. I did it. So proud. One of the fun things about being old is that you can be really excited when your brain works. It just makes you feel good. I can still remember things. All right, here we go. So, oh, meanwhile, there was an oil report today, but who cares? It really means nothing. So here, I'm United, right? And what am I doing? I was operating very profitably at $60 oil. And so today it's 83 bucks or 87 for April delivery. So what do I want to do? I want to take 1/3 of my oil purchases going out until, let's say 29. All right, now notice how here it comes down to 64, 65, right? So here I might even go 2/3. And I start buying outlying contracts. And so now my problem for United, I locked in a rate at $80 going through the end of the year for it's down to 70 in fact, but till the end of the year I've locked in a lot of barrels at an average of like $77 or something like that. And it's only 1/3. So what happens if it starts going up? I'll lock in more contracts, right? But if it starts going down, then yes, I locked in 77, but if it goes down to 50, it's going to go to, then my average is going to be 50, 50, and 77 is 177 divided by 3 is what? Is 60 bucks. So I've locked in 60. So in other words, if it drops, I'll be paying 60 and other people who didn't lock in might be paying 50, but I was profitable at 60. I don't mind that. Understand that? That's my hedge. I have hedged my oil out to there. So my downside is 60. If it goes up to 100 and I've got half at 60, then my worst case becomes 80, which is where we are now. So by locking in a long-term flow of oil for my company, which I definitely am going to use, I'm structuring it so that I can make sure my costs don't go too high. Now, on the other hand, if oil blasts back to 120, and I'm going to be sitting there with my analysts, people like me, and we're going to be looking at it, and if we all decide that that's crazy again, then we could actually sell them, make a ton of money, and then buy them again when they come back down. So, some of the airlines and some of the shipping lines are going to have people who gamble. Now some of them have gotten really killed doing this stuff, but you can also make a huge amount of money. You can offset them. You can have massive gains from just doing the arbitrage on the moves in the oil field. So it's not as out of control as you think. And a good airline like United, like Delta, any good big airline has got a team of guys sitting in a room figuring this stuff out. And unless they're complete idiots, which obviously they're not, because this airline, we've had up and down spikes and all kinds of things happen in the last couple of decades that I'm sure they're very well aware of. And that's how they're going to run this thing. Let me see, where were we? I am so lost now. Here? Yes, haha. Okay. So with ULCC, and this was what? Yesterday. This was yesterday. So yesterday, right here at 350, I said we're going to buy 100 of these fucking things. Because I looked at the numbers, I looked at the math, and I looked at the possible damage for the oil based on what I would do if I was arbitraging their contracts. And I said, this is not going to harm them as much as you think. And not only that though, but this 100/75 where we have here, where we spent $7,000 for our 2028s, right? We're generating $1,000 a quarter in income, and we have 6 quarters left. So not only do we have this massive upside, the upside potential is 7, which is going to be $30,000. So not only can we turn $7,000 into $30,000, but we're going to get the $7,000 back selling premium while we wait. And there's no exposure. I'm doing no puts. We're just selling the 25 uncovered calls. So he said we can sell 25 July 5s for 40 cents. Where's 5? 5's way up there. That's how much bullish, that's how bullish I am. I expect we might be at 5 by July. But even so, those 25 are covered. It's a 175 spread. So we're selling the uncovered 25s, and we're only selling the 25 of them 40 cents. That brings in $1,000. And then 3 months later, 4 months later, another $1,000. 4 months later, another $1,000. We get all of the money back that we laid out for the spread, and we still have the $30,000 spread. No margin is being used to do this. The upside potential is $7,000 plus the income. So it could be double that. It could be $13,000 of upside potential. That's how you play a depressed market. I'm not playing ULCC. We're not playing. We don't care. Well, we do care. We'd like it to go up, but we're going to make our money back on the income sales. So am I going to cut this trade? No, I'm not going to cut this trade. This trade's going to make me money. I'm going to look at every, I have to look, you know, when we go to cash, we got to look at every single trade and say, how sure are we're going to make this money? So VFC, 300% upside potential. ET, I said, let's cash it in. We're too deep in the money. It's not, it only has 20% of upside remaining. I think I said that somewhere. Oh, it's $1,760 on a $2,000 spread. So all we can make is 10% more. No, I'm sorry, 20% more. No, it is 20%. So we can make $340 more. So that's about 20%. So do I want to wait a year to make 20% and have this risk hanging over my head that it pulls back on us and goes back to here? No, screw it. Go to cash, take the money. And we'll, you know, so our default, I'm looking to take the cash. You have to give me a good reason not to take the cash. HRB has been sucking, we're giving up. Sale, it didn't really do anything. It's like we made some money, and but their premise has gotten weak, and we decided to just take the money and get out. Why leave it? And American Airlines, I said we just did a big trade on United Airlines. I don't want to have 2 of them out there, so we cashed out American Airlines too. ARCC has 480% upside potential. I said if that's not good for a new trade, I don't know what is. Also stupidly cheap. Holy crap! I can't believe it's that low. Wait. Oh, I put the same chart twice. That's weird. Barrick. This is Barrick Gold. They have 106 upside, and gold we love, so I think we consider that a good little trade. They already, in fact, it's already in the money. Not this chart, but Barrick's real chart. EPD made too much money, getting out. It's got to be a concept for you guys. You have to have a schedule. You know, this trade should make this much money by this much time, and that means, if you know that, then that means that you divide it by 12. If it's 12 months out, you take the money you're supposed to make in 12 months, you divide it by 12. That's what you should make every month. If your total trade is going to make $12,000, you should be making $1,000 a month. And you're either on track, or you're ahead, or you're behind. And if you're drastically behind, you better figure out why and fix it. And if you're drastically ahead, which is what we had on this one, we're drastically ahead, it's the same thing. Why am I still in this trade if I'm so far ahead? I made too much money to stay in the trade. I'm now risking all the money I made, and I have to wait 12 months or 10 months just to make 20% more. And meanwhile, I'm going to miss all these opportunities for these other trades that make 300% and 400%. Now, you have to take into account how sure you are, but I can tell you that we, obviously within our own portfolio, I'd rather take the cash and put it into trades that I feel are going to give us a stronger return. And it's not 20 versus 30, it's 20 versus 100. So if it's in the portfolio, I must like it anyway. Therefore, I should put the money back in the portfolio, and then I feel more free to make these adjustments. And that's exactly what we did in the set that we just did. Here's Ford, 109%. Good for a new trade. That's in 1 year. A lot don't put most of these in 2 years. This is 1 year. Here's Geo. Geo is a prison-making company, detention centers, and Trump loves his detention centers. He didn't change ICE policy. He just hired a different person to carry it out. But I saw, oh my God, I saw this plan. I forget the number, but the number, it was insane. They're building a detention center, and the plan is to have, I think, 36 people in each cages. Remember the cages that Kristi Noem stood in front of and got a picture taken and everybody freaked out? That's their freaking plan. Just jamming 30 guys in a cage with a toilet and a bar of soap, and that's like their whole plan for housing people. There's no beds. They just basically locking these guys up like animals. And you know who did that? Hitler. That's what a concentration camp was. It was efficient. They treated them like animals. They just locked them in cages and put them together, and ultimately they had that became untenable. So they said, "Oh, I know what? Let's kill them all and gas them and put them in graves." That was the stage 2 of the plan. Stage 1 of the plan is Trump's plan. Build detention centers with the least amount of guards for the most amount of people, keep them in really tight cages of groups so that when you release them for a walk, if you're even going to do that, but if you let them out to exercise or whatever, then you release them, and it's only 36 at a time, which is, you can overwhelm 36 guys, but there's 5,000 people at this camp, at this concentrated camp. It's sick. This is us. This is us. This is America. This is what we voted for. This is being carried out in our names. This is how the world will judge us in the future. So I can't believe we invested in this company. It's so evil. And you know what they're going to say? We were only following orders. That's exactly what Geo's going to say. Hey, we got an order from the government. They said build this, and we built it. And the same thing the guys at Auschwitz said, hey, Hitler was in charge. We've got a government contract. We bid out for a government contract. They said we need a way to house 5,000 people in a normal sized warehouse that you would never think in a million years could hold 5,000 people. We figured out a way to jam all the cages together and keep all the guys together. And we did our job. We were just following the orders. It's so horrible. Anyway, so we did a trade on that, and I said this is like a new trade. It has 85% upside on the spread and 98% upside on the rest. Ugh, and I feel sick even having it in my portfolio. Here's Hewlett Packard. They just had good news, I think. And so things are going well there. And again, this one, it is a new trade. It was a brand new trade. We just did this one. Novo keeps getting hit. Now they got hit with, what's the new thing? NVO. So it's like hit after hit after hit. Cowen downgrades them to hold. cuts the price to 42. Now notice they're at 38, so 42 is fine by me. Oh, I know what it was. This is see, once the animals, what do we call it? Hyenas. Once we call it a hyena attack. In other words, they just keep coming and taking a piece and ripping a piece off and biting and tearing. So it's just all the bad news. Everything that they can throw at these guys getting thrown at them. And it's stirred up because the news items are brought to the attention. Like I call a friend of mine who's a reporter, because I'm a hedge fund manager. I call a friend of mine who's a reporter. I want to take Novo down, and I say, hey, did you see this story? And in this case, the story for today is one they dug up from a couple of years ago. They didn't file their paperwork on time, and the paperwork was bad. The paperwork was the stuff. Ozempic kills people. There's some people who died in their studies, and they didn't, and I mean like a day or two, not like they were trying to hide it, but they did not meet the filing deadline to tell the FDA that their drug killed somebody. And so they did file it, and it went through the process of the system, and in the process of the system, somebody red flagged the file and said, hey, this was late. Bad, bad, bad. Not that the person died. That's not the bad part. It's the fact that it was late. So anyway, so that's what this last thing was today, was that. It's so stupid. And notice that they flatline because everybody knows how stupid it is. But that's what we call a hyena attack. It's when they release the hounds of the press and they just start throwing every day thing after thing after thing gets thrown at them to try to knock their price down so the hedge funds can run in and buy it all up. Which, by the way, is part of like what happens with oil. Like when that guy yesterday said, oh, we escorted the ships and everything's fine. That's to drive the price down. And when the price gets driven down, the hedge fund guys get in. And that's what by the way, Bitcoin's going through that too. Bitcoin is, much as I think Bitcoin is worthless bullshit currency, it still is entrenched enough that it's probably going to keep trading and move forward. So, and by that nature, as it is used in transactions, it gains value. Even though it's completely bullshit, and you could just as easily be trading, pet rocks or something like that. It doesn't matter. It's, if you said every pet rock has a unique shape that cannot be replicated, right? Because it's a rock. If you analyze it with enough data points, you would say this rock is 100% unique and cannot be replicated. It's the only rock like this in the world. It's like a fingerprint, and therefore it's worth $1 billion. Whatever. It doesn't. It's so stupid. That's all a Bitcoin is. A Bitcoin is a unique thing that can't be duplicated, in theory. Quantum computers are going to completely dissolve that. But it's just that the thing is, people want them. It's whether or not somebody wants them or not. And enough people want Bitcoin and believe it has value that, again, you go back to the same thing about gold. Most people buy it and keep it. Most people buy Bitcoin, take it out of circulation, which dwindles the supply and dwindles the supply and dwindles the supply. So in order to shake supply loose, Bitcoin has been purposely crashed and pushed down to levels lower than it probably should be trading at, 66,000, whatever. And that was just to make it possible for the people who were knocking it down to jump in and buy it. They want to buy more before Trump's big announcements on setting up a Bitcoin reserve in the United States. That's what this is all about. Nobody was selling. There was no way to buy any large quantities of Bitcoin until they crashed the market. Suddenly Bitcoins are available. Not that I think he's any kind of genius, but MicroStrategy, or strategy that they're called now, that guy went in and started buying Bitcoin again. He's been borrowing money to buy more Bitcoin. He's like, this is nuts. And we bought some BTC too, which is ETF for it. Here's Owl. Poor Owl is getting completely crashed over nothing. That's another good one to buy. PR, we like them. Did we get out? No, we didn't get out. We just did that. Oh, that's why. It's a pretty new trade, and it went up so fast that we actually got killed by the short calls we sold. But it's fine. Our worst case scenario is we just end up making 41.6%. I'm sorry, that's 41% more than we made. We already made 59%. We can make another 41.6. So we're not done with it yet. And we can actually do better than that if we roll out of trouble. But again, see, here's another thing. Having no margin means we were fully covered. Since we were fully covered, we can't possibly lose money. We didn't, you know, we can only make less than we hoped. That's all it's going to happen. We'll make less than we hope, but we make the money. Margin trading, conservative margin trading is, I mean, conservative options trading with no margin, it's exactly as solid as stock trading. SoFi, and I couldn't turn this one down, so we spent some money. We spent $4,800, a lot of money for this portfolio. We spent $4,800 to re-up this, and now we have $13,000 plus $12,000. We have $25,000 of upside potential on SoFi, and all we wanted to do is, let's see, blah 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 blah. 22. Our target is 22. Here's 22 right there. $22 is our target, and we will make $25,000. So this is now the largest trade in this portfolio. Why though? Because we've been playing SoFi for a long time, and we love it, and we're familiar with it. We know why it's been going down on the channel, and now we think it's a little bit ridiculous. And they just had nice earnings. See the green E? They had nice earnings. They always have nice earnings because they're growing like crazy. They're an incredibly fast-growing company in a space that is 1,000 times bigger than they are. They're like a little turtle going into the ocean, and he's going to turn out to be a big giant tortoise one day. They're just getting started. And they're being sold off like they're toxic, and it's ridiculous. So we like that one a lot. Here's the hedge, SQQ, and this is again a no margin hedge. We got more aggressive because we bought back the short calls on the hedge, which means now we're partially open on the long side, and so we think that SQQ might pop for us. And here's UUU, and they've been crazy. We did an adjustment here. So in the end, here's what we did. We spent, these are our adjustments. We spent $12,287 net dollars. And now because of that, we now have $95,000 of upside potential in our $100,000 portfolio. So the positions we have right now, if we don't do anything else, obviously we have to do our rolls and things like that, but the positions we have in this portfolio now, between now and 2028, we should get a double. That would be obviously 50% a year of gains. We're currently averaging 66% a year, but during that time, we are also going to be putting in $8,400 each year, so we'll put in another $16,000. And we will, of course, still make some new trades and do some new stuff and sell more short calls and things like that. So we will certainly keep up our 66% pace. And if we can keep up our 66% pace, it'll only take us 4 years to get to $1 million. Don't blame me, that's math. I don't, you know, it's the calculator is telling us that. That's the compounds, of course, because next year we'll be making 66% of 200,000. So in other words, those are the adjustments. We're in perfect position to execute, so on and so forth. And so far, we haven't had any really good reason to panic out. All right, so I mean, I strongly suggest going over this portfolio and going back to all the older versions of it, all the previous reviews, wherever they are, all these, and then if you go by these, there'll be more behind that. It's such a great way to learn the whys and hows and what we do for strategy. And then next week, of course, we're going to review all our portfolios if we still have portfolios. That is an unknown factor. But if we decide to keep our portfolios, next week we'll be doing a review. Marco says, see, Pat, you suggested to kill the position on the LTP. Why was this not in the case in the 700? Because it wasn't as risky. No, it just, when I looked at this position at this size, in this proportion, in this portfolio, I make a different decision than I do in the long-term portfolio for that position at that size. You know, here we had no puts, we didn't have any risk. It seems like a very, very simple thing that's going to make money. You can't treat things the same. You certainly can't treat a $100,000 portfolio the same as you treat a $1 million portfolio. Your decision tree is completely different. Your risk profiles are completely different. And again, this is the same thing I'm telling you from before. Can't be absolutist about things. You can't, everything you hear, everything you see cannot become a rule. Everything is situationally dependent. You're almost saying that the last time we got to a red light, I made a right, and now we're getting to a red light and I made a left. Why would I do such a thing? Red lights mean go right. You know, you only have one example, and you're trying to make that into a rule, but it's not. You've got to say, you know, little questions like, which way do I want to go? What's my goal? Maybe I'm not allowed. Maybe it was a one-way street. Maybe I wasn't allowed to make a right turn on this thing. You know, there's so many factors involved, and you're trying to say every time this happens, and it just doesn't work that way. You know, it's like you know, it's like you go to a doctor, and you know, one person said, you know, if I'm having a pain in my chest, the doctor's going to say, oh, we're going to check your heart and blah blah blah, you know, whatever. If a kid is having a pain in the chest, the doctor's going to say, oh, you probably just strained something. That's because the kid's not going to have a kid doesn't have the same physiology that I do. It's highly unlikely that chest pain for a kid is going to mean there's something wrong with the heart. But in an adult, the risk is high enough that I should definitely get that checked out. But that doesn't, you know, you can't start saying, how come you did this for that one and not for that one? There's a lot of reasons that go into that, including the instinct of the doctor at the time, but also including the age, the how in shape they are, the health things, whatever, the historical incidences of there being a problem in the situation. All that has to be taken into account. And it's the same thing with the portfolio. You've got to analyze it and look at each one independently. And that, by the way, is part of the discipline of what I do. I don't know what I'm going to do with the positions before I do it, because there's no such thing as always. I spent all day yesterday analyzing every single position up, down, and sideways, and deciding reluctantly that we were going to keep most of the portfolio. I didn't think that was going to happen. I thought I was going to throw everything out. I was very surprised when Bodie gave me this list and said, keep. And then I read his reasons. He's like, oh, this is good because of that, and this is good because of that, and this is good in this environment. We already did this filtering. We already expected this, not specifically going to war with Iran, but we expected Trump to make a major fuck up and the economy to start collapsing and the consumers to be exhausted and so on and so forth. We expected this year to be shit compared to last year. And we built our portfolio around that expectation. So when things start turning to shit, it turns out all these positions are good. And not only that though, we just made some crazy amount of money. We just made like $8,000, right? 67, yeah. So it was sick. We made 6,000. We put in 700, which isn't really making, but we made $6,000, which is 10% of the amount of positions that we have. That is a hedge. That the extra money we made, I would have not been surprised at all if we had lost money or been flat. But it turned out that we made $6,000 unexpectedly. that $6,000 is now a hedge. So if we lose $6,000 next month, I'll be like, oh, well, we gave it a shot. You know, we didn't cash out, but we lost 6,000 bucks. I'll be like, oh, well, so we're just back to where we were the month before. You don't want to lose 2 months, but it can happen. But the point is, I don't know what's going to happen next month. I don't know what's going to happen next week right now. I know oil is 87.20 right now. That's awful. But and we don't and then we don't know how it's going to affect our particular stocks. But we got to wait and see and evaluate the situation. So that's the answer. All right, last two and I'm done. ULCC is Frontier. Thank you, Steve. Sorry, my bad. I think it's United. Frontier, not quite as good as United, but still the same math. When Ford March 13 call expires, is June the next sale or September? I hope they have July by then, because that's a little awkward. But June, I would go June, not September. I don't want to. I would prefer not to limit. But again, when it happens, we will decide. It depends what's available and whether it's. I want to sell the most premium that I can, based on the target that I expect in the period we're covering. So, you know, going out to June, I'm very comfortable with whatever strike we're at now. Pretty much we're going to sell the June whatever's. If we sell September, now I'm saying, well, there's like 2 earnings reports between now and September, and we could go up and down 10%. It makes it much trickier. So I would much rather sell the Junes, but they may print July and August also in between. Those things may come up. And Brad says, feel better. Thank you. Look, my voice made it through the whole thing. I'm very happy. And it is 2:57. Thank you, everybody, for coming. It's been fun. And let's go and enjoy the war. All right. See you guys next week. Oh, my God. This is such a crazy. It's so amazing to have to sit here and talk about this massive, massive war, you know, and then John Oliver keeps making fun of Robo John Oliver. He keeps making fun of us because he's like, what are you guys doing? Because he's talking about the stock markets. World War III is breaking out, and you're talking about whether Oracle is making money or not. And it is ridiculous, right? You would think we would have something better to do, but we don't. So anyway, thanks, guys, and see you again next week. Take care. There we go.